Right, good evening everybody, and thank you for coming sort of a relatively late event for us, but we're extremely pleased to have Professor John Kay here today. Many of you know him from his many pieces that are in the FT, but specifically here today to talk about the report we produced for the Department of Business, who kindly decided to publish its response today for us. To kind of coincide with our event this evening, so I'm sure that there'll be plenty of questions on the back of that. I mean, I'm a big fan of a lot of the conclusions of John's report, and in particular the fact we were just discussing that you don't need to run the kind of very diversified portfolios which track indices, and you can run much more concentrated holdings and still outperform the benchmark. And I think there's a few good fund managers out there do a really good job of that. But John's got a lot to say on the structure of equity markets, on the structure of corporate governance, on how we can change things for the better. And the plan this evening is John will talk about 20 minutes and then we'll open it up for Q&A. Thank you.
Thanks, and it's certainly kind of odd that we happen to be having this meeting on a particular day that the government has published a response to what I had to say. I don't know how many of you actually read the report. Actually, very few of you, including, except for a rather superficial level me, have actually read the government response. So I will start with a working assumption that no one has read anything very much and see where we go from there. Questions and discussion. What I think is key from this point of view is to repeat the point that I was appointed to do this by Secretary of State for Business. And that actually defined the perspective right from the beginning, which says that we're concerned about how financial markets work from the perspective of companies at one end and savers on the other. That actually seems rather obvious and banal, but actually overwhelmingly the dialogue that surrounds policy towards financial markets and the regulation of financial markets views these issues through the eyes not of the ultimate beneficiaries of markets, companies at one end, savers at the other, but market participants of various kinds. We said right from the beginning that our perspective was in that sense different. In the course of the work we did, I certainly learned quite a lot of things, but I want to pick out three that I think were of central importance. The first to say, and this is particularly significant, was asked to do this by the Secretary of State for Business, is to say that as a source of finance for investment in British business, equity markets don't even register on the radar screen. In fact, if you look over the last 2 decades and strip out the amount of money that was subscribed, most of it by the government, in rescue rights issues for British banks, equity issuance as a whole was negative, not positive. That is the amount of equity that was removed from the market in buybacks and in acquisitions for cash exceeded the amount that was raised in new issues. And over the last 5 years, the IPO market for UK companies has, for practical purposes, essentially been dead. You will discover issues which were made on the London Stock Exchange, but if you go down that list, you will not find many companies that have substantial operations in the United Kingdom, real non-financial operations in the United Kingdom among them. So equity markets are secondary markets, not primary markets. That doesn't mean they're unimportant, but it means the corporate governance function, the business of supervising what it is that businesses do, is not, as it were, an add-on to equity markets. It's actually their central economic function. Second issue is to look at what has happened to the pattern of shareholding in the UK. If we'd been talking 50 years ago, most shares in British companies were owned by private individuals. If we'd been talking 20 years ago, most shares in British companies were owned either by pension funds or by life insurance companies. Neither of these things are true anymore, and the pension fund and life insurance company domination of the share register has been steadily eroded, partly because these funds have themselves become mature and a smaller proportion of total assets, partly because regulatory and other changes have led them to hold less equities in their portfolios, and partly because they have outsourced a great deal of the business of fund management. The result of that is that today the important players in the equity investment chain are asset managers. And the largest 6 to 10 asset managers today account for getting on for, or speak for, getting on for half of in UK shares. The third issue which we raised or discovered is that the chain of intermediation is now extraordinarily long. I emphasized at the beginning, savers at one end of the chain and companies at the other end of the chain. But between them, there are registrars, there are custodians, there are nominees, there are asset managers, there are fund-of-fund managers, there are pension fund trustees, there are insurance companies, there are investment consultants, there are people who provide wrappers, there are platforms, there are independent financial advisors, and I haven't finished yet. There are two problems that creates. One of them is that each of them takes, as it were, a bite out of the cake. And the other is that the proliferation of these intermediaries, all of whom have their own concerns and their own business models, leads to very real potential for misalignment of incentives along the chain. That is, not all of them, in fact, perhaps not any of them, have incentives which are identical with the underlying interests of the companies and the savers. So let us understand that equity markets are secondary markets, that asset managers are now key to the chain, but that there are a great many other intermediaries adding a good deal to the cost. So that is the world in which we operate. That's the equity market side of things. I was asked the question, does the functioning of equity markets lead to more short-term decision-making in British business? And it seems to me the answer to that question is yes. And I can point to three ways in which the answer, or in which equity markets seem to relate to that issue. One is I'm concerned about investment levels. If I look at the OECD rankings of business investment as a proportion of GDP, I discover that Britain is firmly at the bottom of that particular league. And I discover that the United States is typically the second bottom of that particular league. And it might be an accident that these are the two countries with the most active equity markets in that list, but it's certainly an observable correlation. Something similar is true if I look at business R&D. The US does rather better in that, but that's in large part because quite a lot of that funding comes directly and indirectly from the US government. But in some ways, I'm less concerned about investment, about physical investment, because the truth is, as modern business evolves, physical investment is less and less important to the economies taken as a whole than I am by intangible investment of various kinds. Whether one's talking about the skills and the reputation the business enjoys with its customers, and I think we can all think of businesses, and the financial sector services sector is full of them, businesses which have pretty systematically reduced their investment in intangible assets of reputation at the expense of pursuit of earnings per share growth. And that's true also in relation to skills and capabilities of the workforce and of companies themselves. So if we're concerned about physical investment, we need to be concerned about that intangible investment as well. Second area in which we have a problem about short and long-termism is to do with what I came to think of as the dysfunctional earnings management, earnings guidance cycle, in which companies are concerned with quarterly, with their quarterly figures. Sell-side analysts are also concerned with these issues. Earnings guidance becomes important. On the part of an analyst, maintaining the kind of relationships with companies that will enable you to be well informed about how these announcements are likely to develop becomes important. And so you get sucked into a cycle of methods of thinking about companies that have very little to do with the underlying capabilities of the operating businesses involved. So we have a problem with that information management activity. And finally, I'm also concerned about hyperactivity. There are many chief executives of British business today who seem to think of their job as being a sort of meta portfolio manager. That is, they are buying and selling businesses rather as fund managers are buying and selling portfolios of shares. But there are two problems with that metaphor. One is that the costs of buying and selling whole businesses are a lot higher than the costs of buying and selling shares. And the second is that they don't actually seem to be very good at it. And perhaps the most striking manifestation of this is that if we had been talking 20 years ago, Britain's two largest companies would have been ICI, and largest industrial companies would have been ICI and GEC. Where are these companies now? And the answer is both of them were essentially destroyed in their historic form by exercises in this kind of meta-portfolio management that not only undermined several of the businesses, but actually lost a great deal of money for shareholders in the process. If I ask what are the leading chemical and industrial and electrical engineering companies in the world today, the answer is BASF and Siemens respectively, and it's worth at any rate registering that both of these are actually German companies. So in terms of long-term decision making, we have issues about the earnings guidance process, we have issues about investment, and we have issues about overactivity in markets for mergers, acquisitions, divestment. I've always been intrigued by the phrase widely used in the city of corporate activity, which basically means this process of changing a portfolio of businesses, which I've always thought presumably contrasts with corporate inactivity, which is getting on with running the business. So if this is the state we're in and these are the problems we observe, what sort of things should we think about doing about it? Well, there were two broad themes that I thought take one from analysis of the situation to recommendations as to what one should do. And these two themes are trust and confidence and incentives. Now, if you go around the City of London today, you can attend every week, perhaps oftener, a meeting at which people talk about the need to restore trust and confidence in Britain's financial services. And there are eloquent speeches made by leaders of the industry to that effect. I think one's bound to observe that trust and confidence are not really created by people delivering lectures about how honest they are. Indeed, my experience, that may be yours also, is that when someone tells you how honest he is, that is usually a moment at which you should keep a firm hold on your wallet. People who actually justify your trust and confidence don't typically need to spend a lot of time telling you about it. Trust and confidence has undoubtedly been eroded in the financial services sector, but it's been eroded by the ways some people in the industry have behaved, and the only ways in which it will be restored are by changes in the ways in which people behave. Now, people have moved from the stage of believing that 2007, 2008 was some event that hit the city entirely from outside that no one could have anticipated, to being willing to say that there are cultural problems involved, but it's still at the level of cultural problems being the creation of, as it were, a few bad apples. There are much more fundamental issues at work here. Effective financial intermediation is actually about relationships. It is not about transactions and trading. And what financial intermediation exists to do is to enable savers to have portfolios that are liquid and diversified, while mitigating the problems that arise in terms of loss of information and control through that process. And that's something that can only be achieved through the existence of trust relationships. That is, with trust goes the word relationship. And the essence of what has created the problems we observe is the change which has been going on over 20, 30 years, perhaps more, to a world in which financial intermediation was relationship-based to one in which it has been transaction and trading-based. And the transaction and trading environment is simply less capable of generating either the information that is needed to make effective information intermediation possible, or the trust which is actually at the heart of doing it. So the emphasis on the trust and confidence issue is right, but it actually goes to the heart of the changes which we've observed in financial services. The other theme is that of incentives. And when I talk about incentives, I know people's minds are going to turn almost immediately to bonuses. Well, I'm talking a little bit about bonuses in this context, but I'm not primarily talking about bonuses. One of the things that emerged from the evidence we got in the course of the review was a lot of people said this system isn't working terribly well, but it's not our fault. And of course, at some level, it isn't their fault. Most people are behaving in the ways you would expect them to in the environment in which they find themselves. And therefore, if we have problems of behavior, there are issues to do with the environment in which they find themselves, rather than behavior as such. If you think that observation through, you start to see what is at issue in the regulation of financial services, which is that we've spent the 25 years that we've been developing the regulatory regime in Britain, and this is of course not unique to Britain, it's common around the world. The thrust has been to say that if there are perverse incentives in the system, the way we should deal with it is by prohibiting the behavior to which these perverse incentives gives rise. And you don't have to know very much about the regulation of other industries or about the drivers of human behavior to know that that approach is not going to work very well. In fact, to understand the way in which it has in fact developed, which is a regulatory regime that is ever more extensive and intrusive on the one hand, and on the other is largely ineffective in achieving the underlying objectives of the regulatory structure. That is the world in which we have found ourselves. And if we are to move out of that world, it has to be on the basis of a regulatory regime that seeks to influence issues of structure rather than to deal with the behavior which is the product of inappropriate structures. That, interestingly, involves reversing some of the developments which happened in the financial services industry in the 1980s and 1990s. So we have these two basic analytic themes of trust and confidence and incentives.
let me take the last 2 or 3 minutes I have to talk a little bit, and I'm sure we'll do this more in discussion, about how this might be translated into actual practical things that might be done. I would like to start by conjuring up a vision of an equity investment chain which builds on the fact that the role of the asset manager is now central. I'm not unhappy with that. And the informed asset manager who knows a great deal about the companies in which he invests and builds relationships of trust and confidence with the people with the underlying people whose money is being invested, it seems to me ought to be at the center of that particular chain. That's the world we would like to see, and it's a world in which typically investment managers would have more concentrated portfolios with substantial stakes in more substantial stakes in some of the businesses they invest in, and in which investment portfolios are more differentiated from each other than those of the large asset managers who dominate the industry today typically are. And in a world in which that kind of trust and confidence was developed, with a company on the one hand and the saver on the other, would be a world in which much of the rest of the complex and costly chain of intermediation could and should fall away. That's where it is that we ought to be. That's quite a big change. But what can we do in order to help bring that about? Well, what I'm trying to do is, at one level, to put up a vision of industry structure and a rethinking of the way we approach regulation, and then to talk about some specific measures that can push us in that direction. There are 17 recommendations in the report, but I'll focus on 3, or at any rate 3 groups. One is to create some kind of investor forum that would make it easier for major asset managers to act together, which would address some of the issues that are created today by the extreme fragmentation of shareholding in British companies. A second would be the development of good practice statements, and we've emphasized that for company directors, for asset managers, and for asset holders, of which perhaps the most important is to move to a world in which asset holders, pension fund trustees, insurance companies, and the like, are encouraged to believe not just that it's not negligent to say to an investment manager that you have found in whom you have a degree of trust and confidence, go away for 3 or 5 years, see what absolute total return you can make for my savers, and come back at the end of that time and tell me how you have done. It's that kind of mandate that is actually conducive both to the generation of long-term good returns for shareholders and is conducive to the proper relationship, the development of the proper relationships between the company and the asset manager. So we have good practice statements, we have an investors forum, and finally we need to think about what we talked about in the report as fiduciary duties and obligations. That I found gets rather tied up in kind of legal debate about what exactly fiduciary standards in British law are and who applies to them. And who they apply to. That's not actually the central issue. But what is in the concept of fiduciary obligation is central. And there are 2 components to that, one of which is closely related components, one of which is to say that the client's interest comes first. That is what you should be doing as someone who either manages other people's money or handles money, or gives advice on the handling of money, other people's money. That advice should be on the basis that that is what you would do if you were in the shoes of the person whose money you are managing or to whom you are giving advice. And the second part of it is a structure that as far as possible avoids conflicts of interest, and where conflicts of interest are unavoidable, which they sometimes are, they're disclosed to clients, and the conflict is not in itself a source of profit. That is, people should avoid and declare conflicts of interest, and they should put their client's interest first. And I think most people outside the world of financial services would find it extraordinary that there should be any resistance to the application of these principles to relationships across the equity investment chain. But the fact that there is such resistance and it's deeply entrenched tells one how far things have actually gone wrong in the relationship between market participants and end users of markets. Quite simply, over the last decade, as far as equity markets are concerned, companies have more or less ceased to use them, savers have enjoyed extremely disappointing returns, and market participants have in general done extremely well. One only has to spell that out, I think, to see that we've created a situation and a structure which is not sustainable either economically or politically in the long run. And that's what I hope provides the background to the kind of things we proposed. Thanks.
Well, thank you very much for that. I've got a list of questions as long as Mel. I'm sure that there's plenty of questions out there. I'm going to take Chairman's prerogative to ask the first one. Simply because the thought I had when I read your review originally was that there were many things in the report which I agreed with. More concentrated portfolios, longer-term investment horizons, and so on and so forth. But you've got structural changes in the industry in the UK in particular that are actually driving you in the other direction. So, for example, you've got pension fund deficits, and generally what actuaries do is, in the situation you've got a pension fund deficit, they say, well, actually you need to match your assets and liabilities. So for the first time in 50 years, we now have the average UK pension fund with more bonds in its portfolio than equities. Now, where are they going if they're not going into bonds? Well, they're going into hedge funds, because hedge funds offer you absolute returns with relatively low volatility. And hedge funds, by definition...
So they do.
Well,
that's the market.
That's the pitch, and I used to work for one, so I know the pitch. So that's the direction that it's going, and the hedge fund I used to work for took a lot of money in from pension funds who were actually looking for that kind of thing. The recommendations you're making are all well and good, but against that background, where people are moving out of equities, and where those that are trading equities are, or those that own equities are pushing the investments into areas where, by definition, you're going to end up trading and not investing. How do you stop that tide? How do your recommendations, how can they work against that sort of investment tide?
Well, a lot of what you're saying goes back to the point that we've got regulation wrong. And one of the difficulties I have, and I've been talking to a whole variety of groups about these issues over the last few months, but one of the difficulties I have is explaining to people that I am hostile to much of the existing structure of financial services regulation, not because I think everything is fine, but because I think the regulation that we have implemented has in many respects done more harm than good. You know, I've no doubt, to take the worst case, you know, the Basel regulation of bank capital was actually a major contributor to the 2007-8 financial crisis. And it is certainly not a response to that particular observation to say, well, in that case, the right answer is to have more of it, which is the answer that has been generally given. We have to understand better how regulation relates to performance, and that drives back to the fundamental issue that we have to look at issues of structure rather than be prescriptive about behaviour.
I saw a lot of hands, but we'll start here.
Thank you. Julian Wilson, I'm an investor, as you know, John. Thank you. The question's this. I work for
company, as you know, where we invest in a relatively small number of companies. We've made a lot of money for our savers over a period of time. And so some of that is the sort of thing you're saying is a good thing. The problem is, sitting inside it, we know how risky that is because we don't know the future. We're just choosing what we think are the right companies. We are thinking, as it was a few years ago, that the financial system was going to blow up, but we didn't know it. So we're very careful because most of our savers are savers who are professional enough to understand the risks. What do you do for savers who are never going to really understand the risk of getting it badly wrong, where at the moment, by going into an index or a broadly based fund, they are feeling that that risk is lower, and though the money may go down, as time recently has proved, they won't get wiped out, whereas coming into tighter funds, we invested in less companies with bigger positions, is definitely, we think it's the right thing to do, but we don't think it's the right thing to do for everybody.
Well, there are two or three issues bound up in that, all of them I think interesting, and all of them relating in one way or another to the ways we think about and measure risk. One really important thing to say, right at the beginning I think, is that I've come to learn over the last few years the importance of the distinction between risk and uncertainty, and the ways in which the failure to think in these terms, which conditions the whole set of models that are applied by quants in the investment business and by regulators, are based on the assumption that risks can be modeled essentially probabilistically over sets of well-defined outcomes, and realizing that there are only a limited number of things that you can characterize in that way changes the way you think about it. Now, the second issue is then, what do we mean by risk? I think one of the most depressing things I discovered was the extent to which risk in the asset management industry is measured, is essentially tracking error. Indeed, both companies and the regulator will regard tracking error as a measure of how volatile, of how risky a portfolio is. And one of the most, I think, ludicrous and disconcerting discussions we had was with a very large UK asset manager who actually has a style that exemplifies the kind of style I was trying to describe as being the ideal, and has done conspicuously well for his investors over a long period. Discovering on a visit from the FSA that the people were critical because he wasn't measuring his tracking errors, and his explanation that these weren't relevant to his investment process was disregarded. And now he employs a group of people who measure his tracking errors, who are, no doubt, their work is disregarded, but it's something that he and his investors have to pay for. Right, we have to get away from the idea that risk is measured by short-term volatility. Secondly, finally, picking up the point that the world is characterized by this radical uncertainty where we don't know the future. The truth is that the best and only protection you have against risk and uncertainty is diversification. But if you are investing in assets that are genuinely uncorrelated, then the number of holdings you need in order to achieve high levels of diversification is not actually that large. That means, in the sense in which we ought to be thinking of it, what is the volatility of 5-year absolute total returns? It may well be, indeed it is quite likely, that a concentrated portfolio of 20 investments in small businesses may actually be, in that sense, less risky than buying the index.
Buying the index relieves you of tracking error, but it certainly doesn't relieve you of volatility, as the performance of the index indicates.
The message to the smaller saver, for instance, again, talking about portfolio of small companies, that they don't have the access or the equipment to make that decision. So what is it you think ought to be being recommended to them as a way into the investment?
They can have access to a fund manager who makes that decision, and I think they should. Yes, and the fund manager
packages.
Yes, I think that right. I think that's what one would like, and that goes back to the idea of fund managers differentiating themselves more from each other than they currently do.
Can I ask a supplemental to that? When you spoke to Biz about this, did you get buy-in from them to go and talk to the regulators to get them to change that? Because I fundamentally agree with you. If you don't change the regulation, I'm absolutely, by the way, horrified, because I know which fund manager you're talking about. He now has to employ tracking people to do this. Yeah, if the regulators won't change the rules...
Well, I think you can guess what fund manager I was talking about. Some other people may have been able to do the same.
Because I have some of my own money with him. But so I'm totally horrified about this. But I mean, if you can't change the regulators, you won't change the behaviour of the asset managers. What was the feedback?
Right. One of the encouraging things in the response document today is that at least at the level of statement, there is a claim that there is buy-in, you know, from the FSA and FCA and potentially FCA to moving in these kind of directions. And having talked to some of the senior people in these organisations, I think there probably is. I'm worried, and have been worried for a bit, that there is a degree of disconnect between the people who are at the top of these organisations, with whom one has sensible discussions on the right kind of lines, and what the people who actually go about, you know, visiting firms in the industries actually do and think. But that's a problem we have to address.
Right, take this one here, if I may.
Hi, thanks very much. Slightly different track. In the chapter on establishing the right incentives, you talk about asymmetric incentives, and you discuss particularly the example of directors' options as incentives. One thing you didn't talk about, and I was wondering if you looked into, was the ubiquity of limited liability as a way of establishing companies, and whether you think that limited liability, in fact, itself creates asymmetric incentives.
Yes, I think it does, but the problems that have, the moral hazard problems that people have talked about a lot in the last few years, I don't think there were a lot of people in large banks, for example, who thought we can bet the shop on these things because it doesn't matter. If the organisation goes bust, the taxpayer will bail us out. I don't think there's a problem of that kind. Indeed, one had almost the opposite problem, and perfectly clear that some of the people who were managing that risky behaviour deluded themselves into believing that things couldn't possibly go wrong for them. But it does happen in a different way, which is that the people who deal with these organisations, who ought to be the people who are helping provide the constraints on behaviour, they did think that if things went badly wrong, they would be bailed out by the taxpayer. And the fact that they were proved right is exactly what elevates the moral hazard, you know, for subsequent years.
You don't think in a way of incentivising shareholders to be more, take more of an interest in the risks that businesses are taking, would be to remove some of the limited liability. I'm not talking about entrepreneurs, I'm talking about mature companies and financial companies. Would it sort of incentivise those shareholders, and would that have a knock-on effect of reducing the natural size of these companies?
Right, I think it probably would. I mean, in the financial sector in particular, and bluntly we're talking about banks,
If you have a situation in which only 2 or 3% of the capital of the business is being provided by shareholders, then what you have is a business that is not really being financed by equity. And people who are shareholders in it, have typically now an out-of-the-money call option on a very highly geared business that they know very little about. And that's not a situation that is conducive to good investment or to good corporate governance. But, I think we have to address in a much more fundamental way the system of how our banking system operates. And one of the slightly encouraging things is with Vickers and ring fencing and so on, we are finally moving in the direction of structural rather than behavioral solutions. And that's the route we have to go down.
Okay, so just finally, can you see any ambition or intention amongst regulators or government or policymakers to look at things like this, or do you think that's still out of the scope of most discussion?
Right. I think that's still out of the scope of most discussion. But I feel optimistic about the fact that ring fencing is kind of on the way to happening, if only because when we talked about that in 2008, 2009, it was regarded as a kind of off-the-wall proposal. Now it's in the mainstream of public debate. So we can change attitudes at least a bit.
Yes, sir.
Alex Holmes-Chambers, I'm a director of a number of funds. Just make one observation that one of the banks that survived best in the banking crisis was Brown Brothers Harriman in New York. Guess what? Unlimited liability. And it sure had an effect on the risk-taking of them, and it's been a fine bank forever, and it's really done well throughout this banking crisis. My question, however, is that the fund management business, the asset management business has consolidated, and there are a few very large players. It is my observation that people who work in that work for the business, not for their clients, and that a huge number of asset managers are concerned about the profitability of their firm, not unreasonably, and they have short-term incentives. And what I don't understand, and maybe I've just missed it, Professor Kay, what I don't really understand is how do you change fund managers' approach to making an investment from what it's going to do for my bonus at the end of the year to this is a 5-year investment. This company is putting a lot of money into an investment. There are going to be short-term costs to that, but long-term benefits. How do you break that psychological chain in these big money managers?
We have to do a string of things to try and address that. And we talk in the report about what is possibly the most important misalignment of incentives, which is that it can be best described perhaps by saying that fund managers' incentive is in large part, or the fund management business's incentive is essentially to get more funds under management. That is achieved most effectively currently by short-term relative outperformance. That's what directs fund managers to the pursuit of alpha, risk-adjusted outperformance. And yet one makes the point that from the perspective of savers taken as a whole, aggregate alpha is essentially zero. And what can improve either the performance of companies or the performance for savers taken as a whole is only things that enhance beta. That's the basic misincentive that we have. Now, what can we do to address that? Well, I think the two main things that we can do to address it are, one is to move towards the more concentrated and more differentiated from each other portfolios I've described, combined with a move towards persuading people who place funds with asset managers that they are shooting themselves in the foot by insisting on the measurement of quarterly or other short-term relative performance, and that the approach that says you give people 3 5-year mandates that are based on on total return in absolute terms over that period has to be done. We have a number of other proposals that go in that direction as well, but it's that we've focused on that as a central group of problems, and it's only a variety of measures that I think are going to help relieve it.
Can I just ask then, did you consider having a two-tiered capital gains tax structure so that if you made a gain over 5 years, it was tax-free, and if you made it over 6 months or a year, you paid full income tax?
We considered it, but not for very long. Mainly for two reasons. One, it was pretty clear there was, for three reasons actually. One is the rather evident hostility to any tax proposals in this area, which to some degree I share, because I believed ever since I ran IFS that actually tinkering, economic and social engineering from the tax system is rarely a very constructive way to behave. And that's kind of evidenced in capital gains tax, in that in the Brown era we changed capital gains tax more times than anyone could count, without any very large discernible effect on behaviour arising from it. One of the reasons for that, I think, is that actually as far as quoted equity markets are concerned, the proportion of holders who actually pay UK capital gains tax is really quite small. So we looked at that and discarded it.
Gosh, lots. Go here first.
First, I want to come back to your description of where. I want to come back to your description of where things are broken, and I think a lot of things are broken. But I would like to suggest that there's one piece, and you've just touched on it actually, which is more broken than anything else, and that is the piece if you between go from the saver to the company. What actually happens when the asset manager is making his or her pitch to the pension fund and to the consultants to this, is that the measures being used are exactly as you say. They are these short-term benchmarks, or they are the benchmark du jour of the consultant. And I've sort of tried to understand why this happens, and because I think it's only because they can't think of anything else to do. I mean, there is no. You've got the savers who give their money to the pension funds, and they say, well, how are we going to allocate it to these asset managers? We have to come up with some measures. They can't have anything else to do. And so they actually want measures where they can put everybody in one bucket and say, you know, he's good, she's bad, she's worse, she's the best. That's the way the system works. Now, if one that to me is the bit that's broken. But if one takes it out, then what's left? How are people actually going to make the decisions as to whom to give their money to manage?
Well, I have a wider concern about what I think of as bogus quantification, of which we have a great deal in public and business life. And my answer to that, in large part, is to say people should decide who they place their money with on the basis of judgment rather than purportedly objective quantitative information. And what we need to do is move towards a climate in which we're more ready to say it's perfectly all right to do that. As you know, we've been moving in the opposite direction steadily for quite a long time, not to our advantage.
William at the back.
Yes, I'd just like to go back to the point raised by the gentleman here about short and long-term investing. Now, I don't believe that fund managers really can outperform any better on a short-term basis than a long-term basis. I don't have much faith in short-term signals. What fund managers do is they launch lots of different funds, and then they close the ones with poor performance track records. So there's massive survivorship bias in these statistics, and they have an incentive to do that, which is not in the interest of savers. Now, one way you might deal with this is, as you were saying, is to try and encourage people to look up much longer-term track records, or try and get savers to think, what is the investment manager claiming to be able to do, what is his underlying process. But would another approach possibly be to say, you are not allowed to lose the track records of your poorly performing funds? In other words, you will be forced to quote performance histories, which include all of the funds that you have closed, because they're part of your investment process, that's part of your track record. And that would then remove this perverse incentive to launch lots of different funds, see which ones go up, keep those, and close the ones which go down.
While in principle I'm sympathetic with what you're saying, I regard that as another, as it were, detailed regulatory prescriptive type of measure, which I know is going to be as much gained by the people on whom it would be imposed, you know, as the existing measures of that kind we have are. So I don't think we can impose that. I think we've got to educate people into starting to ask these kind of questions for themselves and into learning that the process that you're describing is going on. And I think, with all due respect to the people here who have or who do or have run hedge funds, I think a lot less money would have gone into hedge funds if people understood how much the reported returns of hedge funds are affected by the kind of survivor bias which you're describing.
Actually, I'm going to go to the very back now because that's where I was trying to get to last time.
Professor Kay, I've enjoyed reading your report. I've had a quick glance at what the government has to say about it. I suspect very little, they will do very little in the end. There are a couple of things that come out that I'd like to comment on, if I may, that I've thoroughly enjoyed. The first is your use of the word judgment, which is a word that is sadly lacking in nearly anything I ever read in the investment industry. And more humorously, perhaps, or slightly tongue-in-cheek, is whether or not we should ban all mathematicians from anything to do with the investment business. Because my experience, of course, is that it's the attempt to create certainty where there is no certainty, and the attempt to substitute numbers for judgment that has led the FSA, the actuaries, all the people who advise funds to make exceptionally poor decisions. And I'm not sure how we change the culture of those institutions, rather like with the tracking error. In our own firm, and I'm a fund manager, we always describe risk as the fact that you have less money at the end of the day than you started with, because that's what most people think of risk is. And the only way to do that, perhaps it's diversification, the other is to actually have a more detailed knowledge of what you are actually investing in and having to take a judgment, make a judgment. So that was the first thing. The other thing, perhaps as a question, is in your report you don't address the other side of corporate governance, which is how boards are being selected. Our anecdotal evidence is that the selection process is very poor because it's confused. Governments think, and so do the FSA, that selecting boards is a sort of social process by which different social groups get represented on the boards of companies. I always say to people, when I go and see my doctor, and if I have a serious operation, I'm not really that interested which social group they represent. I want to know if he's the best doctor that knows about my medical condition, can actually operate. We opposed heavily Lloyds Bank's takeover HBOS. It was impossible when you looked at the board, except to understand that none of them really understood any of the risks they were undertaking, because very few people on the board had the qualifications necessary to make the judgments about what it was that Lloyds was proposing to do. So I wonder if we need to radically rethink corporate governance and boards, not from the perspective of social engineering, but from the perspective of getting people on boards who actually know what the business of the company is. Sorry, that was a bit long-winded, I apologise.
Two interesting questions, and in relation to both of them, I'm sympathetic to the direction, but not to the specifics of, or quite to the specifics of where they want to go. I think the issue of judgment is an absolutely critical one, and if you haven't encountered the word judgment, I would strongly recommend a book published, I think it was last year, which it should have received, I think, more attention than it has. It's called A Question of Judgment, and it's by Ammar Bidi. And I thought when I was writing some of the material in the report that he had said a great many of the things that needed to be said rather more clearly and eloquently than I was doing, particularly in understanding the issue of the replacement of relationships by transactions and trading. and the adverse consequences of that. I certainly wouldn't want to ban mathematicians, in part because that's some of the background I myself bring to this issue. But that also is the very important consequence that because I can do these models, you know, I actually, and indeed have spent part of my career actually developing them and teaching them, I think I have quite a lot better understanding of the limitations of these models than a great many people around the industry. So use mathematicians carefully, but don't ban them. On the corporate governance side, you know, I have enormous sympathy with the idea that we are not trying to appoint boards of companies which are in some statistical sense representative of the population as a whole. That seems to me an extremely bad idea. On the other hand, it does seem to me that at the moment we don't have very much diversity in a centrally relevant sense on boards. That the predominance of, you know, middle-aged white men with rather similar attitudes to the world and rather similar reading habits is quite striking. So that I'm against sort of imposed representative diversity, but I think we could do with more diversity of view than, in a broad sense, than we have at the moment. I have a friend who sits on a couple of boards of US companies, and I'm always amazed to talk to him about that as to how he survives, in the sense that his sharpness and arrogance is something that I know would not be tolerated in any British boardroom for even 10 minutes. But I actually think that's the kind of person you need in these kind of environments.
2 points I can agree with more. Put mathematicians back in their box and get people with judgment on boards. Go here.
I recruit board directors for a living, so I might briefly respond to the last question. I've never received a single mandate that asked us to do anything remotely socially representative in terms of a recruitment. Clearly, it was the case on bank boards.
The government was imposing the social representativeness.
And clearly on the banks, there was a lack of financial expertise on those bank boards, although I don't think that was the biggest problem. Equally, I think there was a very real benefit of having non-sector experts on boards who can ask the stupid questions that are often the wise ones. But a more specific question. Many of your issues were addressed by the Stewardship Code under the auspices of the FRC. Did you notice that it's had any effect?
Well, let me take the second part of the question first, which is to say I don't think it did address the issues I've been talking about, and I don't detect it as having had any very material effect. I think in a way you also answered in what you would say the first part of your question yourself, because I don't actually think it was a lack of banking expertise that was an important, on the part of non-execs on boards, but it was an important contributor to the financial crisis. I very much agree with you. You know, that the people who ask the simple common sense questions, would have been rather more useful, you know, than people who believed they had financial expertise. And one should have no doubt that it was the people who believed they did have financial expertise who created the problem, not the people who lacked it. I kind of hark back to my own, perhaps very relevant experience on a bank board of asking the question when Treasury became designated as a separate profit centre, where is the money which everyone claims to make from their profits-oriented Treasury operations actually coming from?
when I asked that question, it was rather as though I'd made a rude noise. And I was sent off to be educated by the traders as to how they did make money. I didn't feel very convinced or very illuminated by the day I spent with them, I have to say. And I think one learnt what the answer to that question was in the end in that particular case, that it didn't make money in the long run, but that's another story.
In your review, you rightly basically summarize some core failings, like Adam Smith's invisible hand not working because nobody actually knows how much it's costing them or where the money is invested, whether they're in a closet index tracking fund, concentrated fund, which you recommend, and everybody has no incentive to actually reduce the overall cost and the underlying return to the return they receive. In the light of that, do you believe any of the kind of empty rhetoric speeches or empty trade body code of ethics or disclosing 10 numbers in 10 different places, do you think any of that will actually achieve the overriding objective to improve the consumer by having one number they can actually trust, just like most report and accounts have, at the bottom, for how much it's really costing, or even actually going as far as the US has been doing since 2004 and ignored by the FSA ever since, of actually showing where the money is invested?
Right. I think there is some disclosure that we need to get better, and it would be useful if we did. And perhaps the most important example of that disclosure is proper disclosure of the aggregate costs of asset management. Having said that, I'm skeptical about what has been another part of a pro-regulatory approach of the last 25 years, which is to say that the answer to almost every problem is greater provision of information. I think useful information is typically generated by people asking for it. And the way we will get useful information, where it's most important of all, which is about the activities and performance of companies, is not by giving ever extended requirements for annual reporting and development of accounting standards, but actually by having asset managers with concentrated portfolios who derive their information through closer contact with a company. And you'll see probably that there's a can of worms hanging on the back of what I'm saying there, which is the issue that it seems to me odd for us to be saying we want to have more engagement by asset managers with companies, but of course if they gain any information through that process that isn't available to everyone else, they're not allowed to trade on it. Incentives created by that structure seem strange.
Neil.
I have two sort of questions, very basic questions. One is about, in your critique of the current system, the relative balance of problems. In terms of the two problems you identified, one was sort of friction, the cost to the saver of all these different links in the chain. And then the second sort of problem is the weakening of the market for corporate control because of the length of the chain. I don't know whether there's some way of you giving me a sense of which of those two problems you think are the more important. My second question really builds on the previous one, which is why doesn't the market operate to drive out and disintermediate all these different costs? Is it just a lack fundamentally the consumers of these products will never be in a position to really do that, or is there some other reason? Is it fundamentally a regulatory thing that prevents that from happening?
Right. I mean, if you ask why markets don't produce efficient outcomes in this sector, either in the financial economist sense of market efficiency, which relates to the information being incorporated in prices and prices being unbiased estimates of underlying fundamental value, or in the much wider public policy sense of efficiency, of bringing about the right market structures. I think what creates the problems, and we devote a little bit of space to this in the report of the review, but it wouldn't be appropriate there to have devoted a lot to it. It is essentially a combination of the issues that arise from the radical uncertainty that I talked about earlier, combined with fundamental information asymmetry being at the heart and integral to the nature of financial services. And we know where asymmetric information is pervasive, we can't expect market outcomes to be generally efficient. And that's what's created, I think, the mistaken idea that the answer to that is to provide lots of more information. It really isn't. You also asked, what is wrong with is it the length of the chain of intermediation creating the poor and the misalignment of incentives? I think it's more, or the short-term behavior. I think it's more the other way around, that it's been the emphasis on trading behavior over the relationship behavior that has created the proliferation of intermediaries. That's what's generated the world in which every time we create a new level of oversight, we discover it creates a demand for yet another layer of oversight to oversee the overseers, as it were.
Right, I'm going to take two last questions. So one here and then Vicky in the back.
While accepting there's a lot of financial asymmetry of information in financial services, there's also a fundamental problem in fund management, which is that it's extraordinarily difficult after the fact, even with all the data, even with all the metrics, or even with any qualitative assessment, to distinguish between brains and luck. Even for the experts, it is phenomenally difficult, and most of them are not very good at it. How one expects an investor to do that, I have no idea.
And what we need to do in life...
Because that is so very difficult, that actually prevents any real skill discovery taking place, and hence any real competition. And marketing can proceed on a victory of hope over experience.
Yeah, right. That's a particular way in which this and some other markets are imperfect, which is you know very little about the quality of the service that is being provided, but it would be worth a lot to you if it were slightly better. So that, and in these markets in particular, competition, especially price competition, tends not to work very well. If you're a doctor, it's not a very good marketing slogan to say, I'm not any better than any other doctor, but I'm cheaper. And we don't observe very much explicit competition of that kind. Right, well, what we instead observe are largely false claims that people are better.
Then the last one.
Can I go back to this diversity issue? Because you raised the point of how better it would be if there had been people asking the sort of simple questions rather than people who thought they understood what was going on. But actually, hasn't it become, because of regulation and what the FSA, or whatever it's going to be, wants, and also possible criminal proceedings against sort of directors who do the wrong thing, and the huge losses that may be there, but actually it's made much more, has been made much more difficult for lay members, if you like, to be appointed on boards of financial institutions. They have to pass all sorts of tests. They have to demonstrate that they've been executives in a financial organization before. So, in fact, the NED appointment has become much, much harder in those places. So are you not worried about that? It would have been nice if there was some recommendation in your report on the corporate governance side on that issue.
Yeah, right. It's a good point that there is no doubt that the boards of several companies we can immediately name did not perform well in the years that led up to the crisis. But, and this is to go back to an answer to a previous point, I don't think the reason they didn't work well perform well had much to do with lack of specific financial services expertise.
I would like to contradict that at some stage.
Oh, right.
Look at it, and there just simply isn't the case. You just go analyse the board of the Royal Bank of Scotland the year before the thing effectively went belly up. There was not one non-executive director who made a bank claim in their life. Not one of them made a derivative. They were all worthy individuals. There was diversity on the board, all of these things. And they single-mindedly bankrupted one of the biggest banks in the world.
Right. Well, let us pursue that for a moment and ask, what was their failure? You know, was it their failure to understand the detail of what it is RBS was doing, which is clear that a significant part of the executive management of RBS did not understand? Or was it the failure to do what, as it were, the grandees who were on that board, it seems to me, were there to do, but failed to do, which was to fire Goodwin when hubris finally overtook him to the point of near mania? I think the job of the non-execs was the latter. And well, in a sense, what was wrong with RBS was you had a board which was capable of doing that, but it failed to do it.
But they didn't have the expertise to ask the right question. They didn't have the judgment.
They had the expertise, but they didn't have the...
No, outside of saying it, but they weren't saying it.
No one can have managed RBS, it's too big. No one can have
exactly. So I don't think it's big. I think it's completely
Okay,
And certainly not the non-execs could not have managed it.
Shareholders, if they had an incentive, because if they'd actually had anything at risk, could have controlled it. They weren't incentivized. Nobody was incentivized. So it grew too big.
Yeah, and we spent some time talking to Edinburgh fund managers, some of whom thought they knew RBS rather well, and asked why they did so little in that phase, to which the general answer was the important thing was to be underweight in RBS relative to our competitors. And that's the essence of the problem.
I'm going to take two very last, and then I am going to wrap it up, one for Sig and then one from directly behind you, and that's it.
On this issue of whether RBS board members were smart financial people or not, you simply have to look at the board of Fortis. Every single member on the board of Fortis was an expert on the financial markets. People ignore Fortis, but they went bankrupt too, as part of the same transaction. So it really isn't a question about expertise. I think you have to go back and take a look at the incentives. And I would be willing to bet you quite a lot of money that most of the directors on each of those boards had financial incentives which were similar to those which Fred Goodwin and the CEO of Fortis had, which are share options.
Okay, right. Very, very, very last question here, and then I'm going to wrap up.
I mean, I'm just wondering, really, that is part of the problem the fact that actually that so much of this is driven by effectively pension investments are basically subsidised by the tax position, and therefore most individuals have no real concern really about how well things perform or not, because basically they get 40% free money. And is it perhaps not better that actually individuals are actually just left to manage their own portfolios on the basis that they can use internet trading into the top 100 or whatever companies, and that the tax people would give incentives back as they would normally through other means? Could that be set up surely in a completely different thing and actually get rid of the main investment community, which doesn't really seem to be doing much good anyway?
I don't see it myself. I mean, if you say for every pound you invest, I will double it, then I think I will be more concerned about how that money is invested, not less.
No, but what I'm saying is that let the individuals, within certain constraints, actually do their own thing through the internet.
There's been
and actually just
catastrophic. Look to the internet boom, or look to the every night.
No, but you could certainly have it on the FT100 or the 250 or something like that. There are certain rules and regulations that you put into it, money out of things, whereas the individual investor doesn't really get anything back at all.
I think there are things we should do to make direct investment by individuals easier, of which perhaps the most important is we should remove the factors which have led to most personal shareholding now being undertaken through nominee accounts. And that's actually not very difficult to do. It's just we have set up vested interests that don't want to bring about that particular outcome. But I think we have to face the fact that, firstly, most people don't want to manage their own investments, and secondly, in most cases, they shouldn't. Right?
Yeah.
I think we ought to learn to live with these two basic facts.
On that note, I am going to wrap up because 7:45 was when I was trying to finish, but I love the faith in the fact that everyone could actually manage their own portfolio. For Professor Kay, I thought that was fantastic. I always thought this was going to be an interesting and heated debate, and I think it has been, and I'd just like to show our appreciation for that speech.